Let us now discuss about cash flow from investments in a bit more detail. Cash flow from investments, two things would be very important. One would be purchase of fixed assets, and second would be disposal of fixed assets. Now, disposal of fixed assets would mean there would be a cash inflow. However, when we talk about purchase of fixed assets, obviously it would be a cash outflow. Now, let us discuss both of these situations one by one. So, when we look at the balance sheet, you'll find that there are cases where we have the gross block of fixed asset being mentioned. Then we also have things like accumulated depreciation, and then we have the net block. Now, what we are going to discuss is that how do we find the amount that was invested in purchasing the fixed assets. So let's assume that this was the year of 2010 and 2011, and let's assume some numbers in between. Let's say gross block was 1000 here, accumulated depreciation was 200, so the net block was 800. So net block is nothing but gross block less the accumulated depreciation, so it is 800 now, net block. Now let's say there was an asset that was bought and the gross block increases to 1200. Accumulated depreciation, the depreciation charged on 2011 will get added here with 2010, so your net block increases to 900. Now sometimes we have seen that students do get confused as to how much has been cash that was invested in purchasing of this fixed assets. So many a times what happens here is that in the balance sheet you're only provided with this net block and you are not provided with the gross block. If you look at this case, how much has been the purchase of fixed asset? Purchase of fixed asset has been to an extent of 200. But when we just look at the net block, we note that the difference is only 100. And many students we have seen apply just the difference between the two and incorrectly calculate the cash outflow because of fixed asset purchase. So how much of cash is deployed in the fixed asset can be found using this shortcut. If you're just provided with this balance sheet net block item, simply apply this formula: difference of net block plus your depreciation expense of the particular year you are talking about. So let's apply this formula here. Difference of the net block, this is 900 minus 800, so difference is 100 here. And what is the depreciation expense which was charged in 2011? This was from 200, it increased to 300. That means 100 would have been the depreciation expense here. So this comes out to be 200. So it actually matches with the actual purchase. So again, to reiterate, many companies may not provide you with this gross block data, only the net block data will be provided, and in that case you must apply this equation, difference in the net block plus depreciation expense, to find the total cash outflow for the purchase of fixed assets. Okay, now let us look at the second case, disposal of fixed assets. Now disposal of fixed asset is again a very unique and important case, because when we talk about fixed asset, a sale of fixed asset leads to two things. One, your property, plant and equipment which is on the balance sheet gets reduced. That happens, number one. And second, your loss or gain, the corresponding loss or gain due to the sale of fixed asset, flows through the income statement. So let us kind of take this balance sheet. You have an asset, you have a liability, and let's say that you had an asset of 1000 and you sold an asset worth 200, so you are left with only an asset of 800 now. So obviously when your asset goes down, your asset which you have sold is to an extent of 200. But there is a word of caution here. Then when we reduce this 200, we are only reducing the book value. So we have sold asset worth 200, which was only the book value of that asset. Maybe the value or the real value or the market value of the asset was 500. Correct? So this can happen, or maybe the real value of the asset was 100. So this would be a loss as compared to the book value. Here in this case, this will be a gain. Here it will be a loss. So when we look at the asset side, our book value reduces here by 200, but our cash goes up by 500. If this was the case, and the difference between the two, 500 minus 200 is basically 300. This 300 flows through the income statement as gain on sale of asset. So this 300 is found on the income statement. So here this gain on sale of asset flows into the net income, and here this net income is related to the shareholders equity, and this shareholders equity increases by 300. So the net effect on the asset side is an improvement of 300, and on the liability side your shareholders equity increases by 300. Thereby your assets are matched to the liabilities. Now how do you take this into account when you are talking about cash flow from investments? Now think from the point of view of pure cash. How much cash did you receive? You received 500. So this is the amount that should go into your cash flow from investments as cash inflows. It has nothing to do with your book value. It has nothing to do with your gain on sale of asset. But since you were to calculate or back calculate the cash inflow because of sale of assets, what you must do is that whatever the change is in terms of asset, change is 200, and what is the gain on sale of asset, that is 300. So this is your cash inflow. If you want to write this in the form of a formula, or if you want to remember how you can apply this in real case, this 200 is nothing but change in asset plus this is gain on sale of that asset. Okay, so with this you will be able to calculate your cash inflows with respect to your sale of asset. So these two equations are very important. One with respect to the purchase of the asset, where you may have to apply on difference of net block plus depreciation expense to calculate what has been purchased, the fixed asset, and second the equation where we have sold the asset and have made loss or gains. So in that case you can apply this equation to calculate the cash inflows.